In 2024, Tesla reported a net income of $7.15 billion, but a free cash flow of only $3.6 billion. Almost half of net income. How is that even possible? In this video, I will show you what these two popular terms mean, how to find them, and why you should trust free cash flow, not net income. Hi, my name is Kevin Zhao, a registered investment advisor that currently manages around $3 million. This content is for educational purposes, not investment advice. Let's get started. First, we're going to start with net income. Net income is basically the profit a company reports after subtracting all expenses like salaries, rent, taxes, and interest. The easier way to think about it is, it's like your paycheck. You get paid, then you pay your bills, and whatever is left is your take-home pay. But here's the catch. Net income doesn't always mean cash in the bank. Why? Because it follows something called accrual accounting. Accrual accounting means companies record revenue when they are earned and expenses when they are incurred, not when cash actually changes hands. So what do I mean by that? Let's look at an example. Imagine Tesla signs a $1 billion car sales contract with Uber in December. On paper, they could record all $1 billion revenue that year, even if Uber hasn't paid yet, and the car will take 12 months to deliver. This can boost the revenue significantly, even though the cash isn't there yet. On the expense side, again, using Tesla as an example, imagine they have to pay $50 million for factory equipment maintenance. Instead of showing that full $50 million hit in 1 year, they could spread the cost over multiple years as depreciation. For example, if they spread it out over 10 years, only $5 million expenses will be recorded each year. On paper, expenses look small, but in reality, they had to pay the full $50 million upfront. Now, let's look at free cash flow. Free cash flow is the actual cash a business has left over after paying for everything it needs to keep the business running, like salaries, rent, taxes, and the cost of maintaining or upgrading its equipment. Think of it like your personal budget. You get your paycheck, you pay for groceries, rent, bills, and maybe fix your car. Whatever cash is left in your bank account at the end of the month, that's your free cash flow. You can find this number in the cash flow statement by taking the operating cash flow and subtract capital expenditures, usually labeled as purchase of property and equipment. For companies, free cash flow is the money they can use to pay down debt, buy back shares, or pay dividends to shareholders. It's real cash, not just accounting numbers. So why trust free cash flow over net income? Investors should trust free cash flow over net income because 1, it's harder to fake. 2, it shows whether the company has real money to survive and grow. And 3, it connects directly to valuation models like discounted cash flow, which tells you what the business is actually worth. Now, looking back at Tesla, in the same year, they reported $7.15 billion in net income, but only $3.6 billion in free cash flow, almost half. If you only look at net income, you would think Tesla had way more money than it actually did. The gap shows you why free cash flow is the safer number to check. To wrap it up, net income is just an opinion, but cash is a fact. Net income can mislead you, but free cash flow tells the truth. Have you ever owned a stock that looked profitable on paper, but the cash flow tells a different story? Drop your story in the comments. I would love to hear them. If you found this video helpful, make sure to hit the like and subscribe button. It will really help me and support the channel. Thank you for watching. Have a great day.